Welcome to the deep dive. Today we're opening what really feels like a legal and financial cold case file.
It really is.
Our mission is a focused forensic investigation into one of the most pervasive and tempting tax myths out there in the world of precious metals.
And potentially one of the most ruinous.
Exactly. It's the idea that you can swap your appreciated silver or gold tax-free for a rental property using a Section 131 exchange. So I want you to just step into the scenario for a moment. It's the ultimate tax-free dream, right? Maybe you were sharp, you bought physical silver when the market was low, say $25 an ounce, and you stacked deep.
A lot of people did.
Right. And now, fast forward, that metal has exploded in value. Let's say it hits $80 an ounce.
Yeah.
You are sitting on hundreds of thousands of dollars in pure profit, and you want to lock that in. You want to move it into something solid, an income-producing asset like a rental house.
Which is a smart financial move, diversifying that game.
It's the logical next step. But here's the problem, the immediate threat. If you just sell that metal for cash, that gain is immediately subject to the U.S. government's collectibles tax.
Yeah, the big one.
The big one. We're talking a maximum rate of 28%. 28! That is a catastrophic slice of your hard-earned profit that just, poof, it vaporizes the second you sell.
It's a huge disincentive to liquidate.
It is. And so out of that frustration, this brilliant idea starts to circulate. You hear it whispered, often from people who, profit from the transaction itself. Don't sell for cash. Use a 1031 exchange. Swap the silver directly for the property. Roll the profits over, defer the tax, pay zero. Just like the big real estate guys do.
It sounds so appealing. It has that ring of, insider knowledge.
It sounds like smart money talking. But here's the urgent question at the heart of this dream. Does it actually work? Or is it the most dangerous myth in the metals world?
And we have to be really clear on this right from the top.
The initial warning is this. That strategy died. Legally, it died in late 2017. Attempting it today doesn't just trigger the 28% tax bill you were trying to avoid. No. It sets you up for an automatic audit, a full tax bill, and on top of that, a penalty for negligence.
Because you ignored, 7 years of clear statutory law at this point?
Exactly. So our mission today is to move past the gossip, open the forensic file on Section 131, and expose the exact moment the rule changed. We're going to analyze the difference between real and personal property and, most importantly, find the real compliant ways for you to achieve tax-advantaged growth.
And that forensic investigation framework is so important because we're not just looking at the law today, which is, crystal clear. We need to understand why the bad advice is still out there.
That's the real mystery.
It's a fascinating case study in financial psychology, really. People want to avoid that 28% rate so badly that they're willing to believe in loopholes that were sealed shut by the Tax Cuts and Jobs Act of 2017.
The TCJA. We're going to be talking a lot about that.
We are. We're going to trace the legal death blow, explain what Congress restricted, and show you exactly why swapping a piece of silver, which is personal property, for a building, real property, just agreed, it fundamentally breaks the whole system.
But this isn't just about pointing out problems.
No, absolutely not.
No.
We're here to deliver solutions. We're going to dedicate a lot of time to the superior compliance strategy, which is the self-directed IRA, or the SDIRA.
A magic wrapper.
That's it. It's the legal force field that allows for genuinely tax-free compounding in exchange, but you have to do it inside the right environment. What's fascinating here is how persistent bad advice can be. Yeah. Investors are chasing ghosts, really, guided by people whose only incentive is a transaction fee. Our goal today is to arm you with the truth.
Okay, so let's start at the very beginning. Let's really detail the anatomy of this tax trap, because the desire itself is completely rational. You've got a massive gain. You want to protect it from a massive tax bill.
Perfectly logical. Nobody wants to give up 20% of their profit if they don't have to.
And the allure of this tax-free swap is so powerful because, historically, the 1031 exchange was a cornerstone of American tax strategy. I mean, real estate investors use it constantly.
All the time. It's how fortunes are built in real estate.
Yeah.
You roll profits from one building into the next, and you never trigger a taxable event.
So there's this psychological hook, right? If the law gives this incredible benefit to one major asset class, why wouldn't it give it to another traditional store of value like gold or silver? It feels like it should work.
And that desperation that it should work feeling is what feeds the myth. And that leads us right to the source of the bad advice. Certain dealers, facilitators, people who are not certified tax advisors.
Their motivation isn't your tax compliance.
Not at all. Their motivation is securing fees. They get paid when the assets move, not when your tax return is accurate. Imagine you have, say, $300,000 worth of appreciated silver you want to turn into a rental property. The dealer's incentive here is, well, it's perverse. They might get a fee for buying the silver from you, and then they might get another fee or a kickback for facilitating the exchange into the real estate. Their paycheck depends on the deal happening.
So this is the critical forensic question we have to ask. Why? Why would they keep promoting this when the rule is so clear now?
The sources make it pretty clear. It's because it secures the transaction. The second they convince you that swapping that silver for a house is tax-free, they've just solved your single biggest problem.
The 28% tax fear, it's gone.
Exactly. If you believe the 1031 paperwork is some kind of magical shield, you move forward with the deal. They might even whisper these dangerous half-truths like, oh, the IRS never checks these small deals, or we'll just structure it as a personal property exchange.
Which is just legally unsound and financially negligent.
Completely. And that brings us to the real, concrete consequence of trying this today. Let's invent a person. Let's call him Mr. Jones. Mr. Jones bought a stack of silver for $100,000. It's now worth $400,000. That's a $300,000 capital gain.
A nice problem to have.
A great problem to have. So in 2024, based on his dealer's advice, he attempts this 1031 swap for a rental property.
And then the audit letter arrives.
And it absolutely can.
Sure.
Especially with unusual 1031 filings, the IRS will look at that paperwork and they will disregard it immediately.
Why? Just spell it out.
Because the underlying asset, the silver bullion, is not a qualifying asset. The law, post-2017, dictates that Section 131 is for real property, period, full stop.
So that paperwork he filed is basically meaningless.
It has no legal weight in this context. The auditor just dissects the transaction into two parts. Step 1, Mr. Jones sold a non-qualifying personal asset, the silver, generating a $300,000 capital gain. That gain is now realized.
And taxable.
And taxable. Step 2, he used that money to buy a new asset, the house. The tax liability was triggered back in Step 1, 28% of $300,000. That's an $84,000 tax bill.
Ouch. But you said it gets worse.
It gets worse. It's not just the tax bill he was trying to avoid. Because he filed an incorrect 1031 form and didn't report the gain, the IRS is going to hit him with interest on that unpaid tax, and then potentially a penalty for negligence or for substantial understatement of income.
And his big defense is, but my dealer told me it was okay.
And that defense holds zero weight in tax court. Zero.
Why not? I mean, he was acting on what he thought was professional advice.
Because the tax code is explicit. The burden of accurate tax reporting lies squarely on you, the taxpayer.
Yeah.
You can't outsource your legal compliance to a salesperson whose goal is a commission.
So unless that dealer is a licensed tax advisor who puts that advice in writing and is willing to stand behind it,
It's worthless. And you're the one who ends up paying the 84 grand plus penalties and interest.
So the core takeaway here is foundational. You do not make a six-figure tax decision based on a sales pitch.
Never. You have to base it on the verifiable language of the tax code. And that's where we're going next, to prove conclusively why that language now shuts the door on precious metals.
Okay, let's unpack this. Let's establish the timeline of death for this myth. To really get it, we have to look back at the world before 2017, because back then, the 1031 exchange was, it was much broader. The term like-kind was a lot more forgiving.
It was a very different landscape. Before the Tax Cuts and Jobs Act of 2017, Section 1031 had this really sweeping scope. Like-kind just meant that the asset you were selling had to be of the same nature or character as the one you were getting.
And the critical part is that it covered both real property, you know, land and buildings, and personal property.
Yes, and personal property was basically everything else. Cars, equipment, artwork, and yes, potentially metals.
So that broad definition allowed for some really creative swaps.
Incredibly creative. It's what gave rise to this whole myth in the first place. As long as the assets were sort of in the same class, you could make a case.
So you'd see things like, what? A painting for a painting.
Absolutely.
Yeah.
The sources cite classic examples. A collector could swap a major painting from, say, the Impressionist school for another Impressionist painting and defer millions in capital gains.
And businesses did this too, right?
Constantly. A business could swap a giant piece of manufacturing equipment for another piece of heavy machinery, or, the famous example, swapping an entire fleet of old company cars for a new fleet of work trucks.
All of that was personal property.
All of it. And because things like artwork and vehicles qualified, some clever investors were able to argue, sometimes successfully, that metal-for-metal swaps should also qualify. Silver bars for gold bars.
And that's the historical precedent the dealers are still clinging to.
They're clinging to a law that doesn't exist anymore. Because the key distinction, the thing Congress went after, was that difference between real property fixed assets and personal property movable assets. The TCJA didn't just tweak the rules for personal property. It blew up the whole category.
So this is the moment, the exact moment the myth died was December 2017.
That's it. The Tax Cuts and Jobs Act permanently restricted Section N31 exchanges exclusively to real property. It was a surgical strike. Definitive.
And what was the motivation for that? Was it just to close loopholes?
That was a big part of it. It was a move to simplify the tax code. Imagine the administrative headache for the IRS trying to value all these bizarre swaps, baseball cards for farm equipment.
Right.
But it was also to focus the benefit of tax deferral on long-term fixed investments like real estate, which you can argue have a more direct impact on local economies through development and housing.
So let's be super specific then.
Yeah.
What is real property under the law today?
It's defined very narrowly now. It's land, it's buildings, it's permanent improvements to land, commercial centers, things that are fixed, immovable, tied to the earth.
And everything else that used to qualify.
It's now on the exclusion list. And that list explicitly includes the very assets we're talking about: precious metals, gold coins, silver bars, artwork, classic cars, even modern things like cryptocurrencies.
So trying to swap silver for land today is it's legal absurdity. You're trying to use a tool designed only for asset class A and something that is squarely in asset class B.
The asset classes are legally disconnected by federal statute. It's like trying to use a key for a house to start a car. It's the wrong tool for the job.
So let's go back to that two-transaction view you mentioned. When the IRS auditor opens that file, what's the legal disconnect they see? What's the principle at play?
It all comes down to a core tax principle called constructive receipt. It's about when a gain is considered realized.
Okay, what does that mean in plain English?
It means that even if you never physically touched the cash, if you dispose of an appreciated asset and receive something else of measurable value for it, you have realized the gain.
You gave an analogy before about paying rent.
Right. Let's say you owe me $50,000. Instead of writing me a check, you just pay my $50,000 rent bill directly to my landlord. Did I ever touch the money? No. But did I receive the economic benefit of it?
Absolutely.
Yes. The IRS would say I constructively received that $50,000 and it's taxable income to me.
So in the 1031 scenario, the IRS doesn't care that the silver went to some third party who then funded the house purchase.
They don't care at all. They see your valuable asset, the silver, was disposed of. It was converted into a cash value that was then immediately used to buy something else that was not like kind.
And that moment of conversion, that's the taxable event.
That is the realization event. Precisely. Because the silver is now a non-qualifying personal property asset, the continuous exchange that 1031 requires is instantly broken. The law forces you to recognize the gain on the silver sale before you buy the real estate.
Which triggers the immediate 28% collectibles tax, the very thing you were trying to avoid.
Exactly. So this is not a gray area anymore. It's not up for debate. This is statutory law, and it's been on the books for 7 years. Any advice promoting a 1031 for metals is either based on profound ignorance or, worse, it's intentionally deceptive.
Okay, so we have established, I think, pretty conclusively that swapping silver for land is legally impossible. But there's always this one theoretical gray area that pops up. It's the argument dealers fall back on when you challenge them.
The metal for metal swap.
Exactly. The question is, okay, fine, I can't swap silver for a house. But what if I have $200,000 in appreciated gold eagles and I want to swap them for $200,000 in gold maple leafs? Bullion for bullion. Gold for gold. Doesn't that satisfy the old definition of like kind?
And that's where you have to understand the historical nuance. Because even before 2017, these swaps were always considered high risk. The IRS has always made these very sharp distinctions based on the intent behind the asset and how it's valued.
So you're talking about the difference between bullion and numismatics.
Precisely. The IRS has specific rulings on this. They've made it clear that generic gold bars, whose value is 99.9% based on their metal content, are not considered like kind with a rare collectible coin like a St. Gaudens.
Even if they're both made of gold.
Even if they're both pure gold. The sources really emphasize this. The IRS looks at the intent. When you buy a generic bar, you're buying a commodity. Its value is its weight. When you buy a rare coin, you're buying a collectible, a piece of art. Its value is based on rarity, condition, historical significance.
So they serve different investment purposes. One is metal, the other is art.
And because of that, the IRS says they are not like kind. So even under the old rules, swapping a commodity for an art piece was a no-go. Now, to your specific question, a gold eagle for a gold maple leaf.
Yeah, they're both modern bullion coins, valued by weight.
Right. And historically, tax experts argued that this specific swap might have just barely met the old like-kind test. But here's the extreme risk warning we have to deliver.
That historical interpretation is now completely irrelevant.
It's a moot point. While the assets themselves might feel like-kind, the TCJA restricted the entire 1031 mechanism to real property. The law didn't say you can't do personal property swaps unless they're really, really like-kind.
Right, there's no exception.
No, it removed the whole category. So trying a metal-for-metal swap today is still an attempt to use a tax deferral tool that has been repealed for that entire asset class. The statute overrides any narrow interpretation of asset similarity.
That is such a critical point people miss in online forums. They say, well, the code doesn't say you can't exchange gold.
But it does. It says you can't use a 1031 for personal property, and gold is personal property. The result is exactly the same. The legal mechanism is gone.
So why on earth would anyone still recommend this? Is it just that they think they won't get caught?
That's a huge part of it. A perception of low risk. It's not a registered real estate deed, so it's harder for the IRS to track. People feel they can slip through the cracks. But that is a fatally flawed assumption. If you get audited for any reason, this illegal 1031 attempt will be found, and it will be penalized.
So the conclusion is simple.
It's firm and simple. The safest, most legally defensible assumption is that there are no 1031 exchanges for precious metals at all, period.
Okay, to just hammer this point home, there's a specific compliance instruction that comes from the most conservative sources. The private letter ruling, or PLR, what is that?
A PLR is the only real safe harbor. It is a personalized, legally binding ruling from the IRS, issued to a specific taxpayer about a specific transaction. It is literally the IRS saying, yes, for you, in these exact circumstances, this is legal.
So unless you have one of those in your hand,
Do not attempt any tax-free swap involving metals. And a dealer's word is not a PLR. Your accountant's opinion is not a PLR. And getting a PLR is expensive, it takes forever, and given the TCJA, the odds of getting a favorable one for a metal swap are basically zero.
the fact that you need one at all just shows how risky the general practice is.
Absolutely. If the only way to be safe is to get special personalized permission from the IRS, it means the default action is inherently dangerous. Any dealer promising this without that PLR is just pushing a high-risk gamble to make a commission. And you're the one taking all the risk.
All right, so we have slammed the door, locked it, and thrown away the key on the 1031 exchange for metals. Let's pivot now to what actually works. What do successful, compliant investors do?
Yes, let's talk solutions. Because the goal isn't to find a dead loophole. It's to use the existing tax architecture legally and intelligently. And the answer isn't a swap, it's a wrapper.
The self-directed IRA, the SDIRA.
This is the superior compliant alternative. This is the legal structure that actually lets you do what the 1031 myth promised. Interchange assets without triggering a taxable event.
So how does it work? What's the magic of the wrapper?
The SDIRA changes the legal owner of your assets. Instead of you, the individual, owning the gold, which means you pay capital gains when you sell the IRA, this legal entity, owns the assets.
So it's like a legal force field around your investments.
That's a perfect way to put it. It shields the gains from taxation until the money is withdrawn. And if it's a Roth IRA, maybe not even then.
Okay, walk me through the mechanism. Let's use that same example. I have silver, it's appreciated, and now I want to buy a rental property. How do I do it in an SDIRA?
Okay, so let's say you chose a self-directed Roth IRA. You make your annual contributions, and with that cash inside the Roth, you buy $200,000 worth of silver. It appreciates to $500,000.
A $300,000 gain.
Right. Now you decide you want that rental property. So you instruct your SDIRA custodian to sell the silver. That $500,000 in cash goes right back into your IRA cash account.
And because it never left the IRA?
No taxable event is triggered. The IRS doesn't see a sale for a personal gain. They just see a rebalancing of assets within a protected account. Then you use that $500,000 cash in, still inside the IRA, to buy the rental property.
So the property is now owned by the IRA.
Correct. And you have legally and seamlessly moved $300,000 of appreciation from silver into land, entirely tax-free. You've bypassed the 1031 mess, and you've bypassed the 28% collectibles tax.
This is the critical difference. This is the government-approved vehicle for doing this kind of thing.
It's the designated pathway. If your choice is between a dead loophole and a clear legal mechanism that eliminates the tax entirely, there's no contest. The SDIRA wins every time.
But let me play devil's advocate for a second, because we hear this from listeners. An SDIRA isn't simple. You've got high custodian fees, specialized administrators, and a lot of rules, right? Like the self-dealing rules. Is this really better for the average person?
That is an excellent and fundamental question. And yes, SDRAs are more complex, they have higher fees than a normal brokerage account, and the rules are strict. If the IRA owns the rental property, you can't go over there and fix the toilet yourself. You can't live in it. Those are prohibited transactions.
So does the compliance headache eat up the tax benefit?
Let's just look at the numbers. Let's go back to that $300,000 gain. In a personal account, you pay $84,000 in tax immediately. In a Roth SDIRA, that tax is zero forever. So even if you pay, say, $1,000 a year in custodian fees for 10 years, that's $10,000 in fees versus an $84,000 tax bill.
Okay, when you put it like that.
For any significant appreciation, the tax benefit just overwhelmingly crushes the administrative cost. It's an investment in tax certainty.
But now we have to talk about the crucial limitation. This is great for future investments. What about the person who already has a big stack of silver in their safe at home?
And this is where a lot of people make a potentially catastrophic mistake. They assume they can just take that physical metal and contribute it to their new SDIRA.
And you can't do that.
You absolutely cannot do that. It violates multiple rules. First, you can generally only contribute cash to an IRA up to your annual limit.
Why is that?
Valuation. The IRS needs to know the exact value of what you put in to make sure you don't go over your contribution cap. How do you value a bar of gold on the exact day of contribution? But more importantly, the IRS views moving an asset you personally owned into your own tax-sheltered account as a form of self-dealing. It's a prohibited transaction.
And the penalty for that is bad.
It's disastrous. It can lead to the entire SDIRA being disqualified. All your tax deferrals could become immediately taxable, plus penalties. It's a huge, huge risk.
So the takeaway is firm. The SDIRA is a proactive strategy. For your existing personal holdings, you either have to bite the bullet and pay the tax when you sell, or you use one of the other strategies.
Exactly. And for people with really large gains from personal metals, there is another more complex exit ramp, the Qualified Opportunity Zone Fund, or QOZ.
This came out of the same 2017 tax law, right?
It did. It's designed to let investors roll big capital gains into investments in designated economically distressed areas.
How does that work? Let's say I sell my personal stack and have a $500,000 profit.
You have a strict 180-day window from the date of the sale. You can take that gain, just the $500,000 in profit, not the original principal, and roll it into a QOZ fund.
And what do these funds invest in?
Typically real estate development in those zones.
Yeah.
Building new housing, commercial properties, they're very
But
specific.
then the tax benefit.
It's twofold. First, you defer paying that initial 28% tax on the metal gain until at least the end of 2026. That's a huge immediate cash flow benefit. But here's the real kicker. If you hold that QOZ investment for a full 10 years, the appreciation on the QOZ investment itself, the new growth, is entirely tax-free.
So you defer the first tax bill and then get tax-free growth on the new investment.
Exactly. It's incredibly powerful. But, and this is a big but, it's really for high net worth individuals. QOZ funds usually have high minimum investments, 6 or 7 figures, and you're locked in for 10 years to get the full benefit. It's not for the average person.
So what about that average person, the person who needs liquidity now but just can't stomach that 28% tax hit?
There is a simple, elegant play that the wealthy use all the time.
Yeah.
A collateralized loan.
So instead of selling the gold, you borrow against it.
Precisely. You take your bullion to a lender that specializes in this. They'll lend you maybe 50 to 75% of its current market value. You get cash, but you still own the metal.
And the tax advantage.
It's profound. Loans are debt, not income. The IRS does not consider a loan a taxable event. You get the liquidity you need without triggering any capital gains tax at all.
That's a great option if you think the metal is going to keep appreciating.
It's perfect for that. You avoid selling, you get cash for a down payment or whatever you need, and you just pay the interest on the loan, not an $84,000 tax bill. These three mechanisms, the SDIRA, the QOZ, and the loan make the 1031 myth completely obsolete.
Here's where it gets really interesting. We've shut down the myth, we've laid out the real solutions. Now we have to ask the big question. Why were people so desperate for a loophole in the first place?
And that gets to the heart of the whole thing. It comes down to the fundamentally punitive tax structure that's applied to precious metals in the first place.
We need to analyze this collectibles tax. The IRS basically puts gold and silver in the same category as fine art, antique rugs, stamps.
And collections, exactly. Yeah. It's classified as a collectible, and that classification, not the asset itself, is what determines the brutal tax rate.
And that rate, let's say it again, is a 28% maximum capital gains tax rate.
28%. Now let's contrast that sharply with what the system seems to favor. Stocks, bonds, mutual funds, ETFs, real estate.
What's the rate on those?
For most investors, the long-term capital gains rate on those assets falls into a much more favorable 15% to 20% bracket.
So that's an 8 to 13 percentage point difference. That is gigantic.
It's a massive difference. Imagine two people. In 2010, one puts 100 grand into an S&P 500 ETF. The other puts 100 grand into gold bullion. Both double their money. The stock investor pays maybe 15 or 20% tax on the profit. The bullion investor pays 28%.
Same success, but a huge tax penalty for choosing the tangible asset.
A dramatically higher penalty. And this brings us to the core dilemma in the source material. Should gold and silver be considered money, which would imply a much lower tax rate, if any, or should they be stuck in this collectible category and penalized?
What's the argument that they're not collectibles?
Proponents argue that the IRS definition is just archaic. Gold and silver function globally as monetary instruments. They're a hedge against inflation. They're a store of value outside the banking system. Buying a gold eagle isn't a hobby like collecting stamps. It's an act of monetary self-preservation.
And the collectibles tax wasn't designed for that.
Not at all. It was designed to hit wealthy art collectors and speculators in luxury goods. To apply that same 28% penalty to someone saving for retirement in silver bars is seen as punitive. It's seen as discriminatory against hard asset investors.
So the core argument really is, why should the person who bought a paper asset, an index fund, be taxed so much less than the person who bought physical gold to protect themselves from the risks of that very paper system?
Right. The high tax rate is an explicit disincentive. It pushes you away from holding physical wealth outside of traditional markets.
And this debate brings it all home for you, the listener. It forces you to make a personal choice. You have to weigh the trade-offs. Are you willing to pay that higher 28% tax to maintain direct physical control over your metal?
Or do you prefer to use the SDIRA wrapper? You give up some control, you have a custodian, you have rules to follow, but you get that tax-free compounding.
The 28% rate is an economic pressure point.
It is. It forces you to think about where you want your assets. But for some investors, that 28% is the price of freedom. The price of having unrestricted access to their wealth with no third-party interference. They'll gladly pay it.
So if we connect this to the bigger picture, the debate is valid, but the law is the law.
For today, yes. While lobbying efforts continue until Congress reclassifies bullion, you have to focus on the compliance strategies. You have to work within the system as it exists, not as you wish it existed. And the hardest lesson is this. Don't let your desperation to avoid the 28% tax blind you into falling for the illegal 1031 myth.
Okay, we have closed the forensic file on this one. Let's just quickly summarize the 3 key takeaways you absolutely need to remember from this deep dive.
Number 1, and this is the big one. Forget the 1031 for precious metals. The 2017 tax law restricted it to real estate only. Gold, silver, all personal property, they're out. If a dealer suggests it, they are giving you dangerous advice.
Second, use the SDIRA. For all your future precious metal investing, start with the self-directed IRA wrapper. It's the right tool for the job. It lets you sell silver to buy land, or vice versa, completely tax-free inside the account. It eliminates the 28% collectibles tax.
And third, consider the collateralized loan. If you have personal holdings and you need cash today, don't sell and trigger that huge tax bill. Borrow against your bullion. A loan is not income, so it is not a taxable event. You get liquidity without realizing the gain.
The sources really suggest that for the average person with a personal stack, the choice often comes down to either accepting the tax or just holding on forever. And that brings up a final provocative thought we want to leave you with.
Right. This connects the tax debate to estate planning. You never sell, you never pay the tax. So we want you to really think about the ultimate long-term strategy, holding bullion for generations.
As generational wealth.
As generational wealth. What is the value of holding that physical asset, knowing the tax liability is only deferred until it passes to your heirs? This forces you to consider the step-up in basis rule at death.
Explain that quickly.
If your non-IRA gold passes to your heirs, its cost basis gets stepped up to whatever the fair market value is on the date of your death. This can potentially wipe out the entire capital gains tax liability for your lifetime of appreciation.
So your heirs could sell it tax-free, potentially.
Potentially, versus a Roth SDIRA, where that wealth is just transferred entirely tax-free anyway. This pushes you to explore real estate planning tax deferral versus tax elimination. And that is a far more productive and legal path than chasing a ghost, than chasing a defunct 1031 loophole. You have to ask yourself, what is this metal really for? Is it for your liquidity needs now, or is it for multi-generational protection? And that answer should dictate the compliant wrapper you choose. That's the real question to mull over.